Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. Today's show is sponsored by the Cost Segregation Guys. If you own investment real estate and haven't looked seriously at cost segregation, you could be leaving significant tax savings on the table. The Cost Segregation Guys help investors accelerate depreciation, improve near-term cash flow, and make more efficient use of capital, all without changing the underlying asset. In a business where preserving cash matters, that's worth paying attention to. If you're interested in learning more, click on the link in the show notes and you'll be able to connect directly with the Cost Seg guys and qualify for a discount because you came directly from the show. Now, today, I want to talk about a topic that's poorly understood by many investors, but it has a direct impact on every mortgage, on every construction loan, and every real estate project. I'm talking about Federal Reserve swap lines and why they're so important to maintaining stability in the bond market. Now, recently, Treasury Secretary Scott Bessent testified before Congress and made a statement that caught my attention. He said, swap lines are to maintain order in the dollar funding markets and to prevent the sale of U.S. assets in a disorderly way. At first glance, that sounds like technical language, but buried in that sentence is something every real estate investor should understand. So let's start with a simple observation. Most people think that interest rates are set by the Federal Reserve, and that's only partly true. Fed controls short-term rates, but mortgage rates, commercial loans, construction financing, agency debt are all influenced heavily by the bond market, specifically the US Treasury market. And the Treasury market is at the foundation of the global financial system. When investors buy Treasury bonds, yields fall, and when investors sell Treasury bonds, yields rise. And when the yields rise, the cost of borrowing for everyone throughout the economy goes up. So let's connect that to global demand for dollars. The US dollar isn't just America's currency, it's the world reserve currency, and international trade in oil, commodities, countless financial transactions are conducted in dollars. As a result, governments and financial institutions all over the world need access to dollars. Most of the time, that's not a problem. During periods of uncertainty, demand for dollars can surge. Now, we've seen it repeatedly. We saw it during the financial crisis, during the pandemic, and now more recently in the conflict in the Middle East. Several Gulf states needed greater access to dollar reserves because their oil revenue dried up. As demand for dollars increased, the value of the dollar increased as well. That's simple supply and demand. So all of a sudden, if a country needs dollars and doesn't have enough, and those dollars cost them more to convert, the only option is to sell assets. Many countries hold large quantities of US Treasury bonds. If enough institutions begin selling treasuries at the same time, bond prices fall and the yields rise, and that's where the problem starts. Higher Treasury yields quickly flow through the financial system. Mortgage rates increase, commercial borrowing costs increase, development projects become harder to finance, property values come under pressure. Projects that worked financially 6 months ago all of a sudden stop making sense, and that's exactly the situation policymakers want to avoid. And this is where swap lines come in. A swap line is a temporary agreement between the Federal Reserve and another central bank. The Fed provides dollars in exchange for the foreign currency, and the foreign central bank can then provide those dollars to banks within its own country. It's a pressure relief valve of sorts. Instead of forcing institutions to sell Treasury bonds to obtain dollars, the dollars are temporarily made available through the swap line. The way that's done is those central banks will post collateral with the Federal Reserve, usually the Federal Reserve Bank of New York. The result is a more stable Treasury market, and a more stable Treasury market means more stable interest rates. Now, people mistakenly view swap lines as some kind of foreign aid. They're not. They're designed to maintain orderly financial markets. So when Bessent says, when he talked about preventing disorderly sale of assets, he was talking about preventing the type of forced selling that can destabilize the bond market, and specifically the market for U.S. Treasuries. Real estate investors spend a lot of time studying rents, demographics, vacancy rates, supply pipelines, and those things matter, but the cost of capital matters just as much, if not even more. The Treasury market sits at the center of that equation. The financial plumbing of the system is not very exciting to talk about or even focus on. In fact, most people don't even think about it. But when the plumbing stops working, everyone notices. And that's why maintaining stability in the bond market remains one of the most important ingredients in keeping borrowing costs lower and preserving a healthy environment for real estate investment. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.